Listen, if you have the means to pay off your house, cool. But there's more that goes into it than just saying, all right, I'm going to pay off my house and seeing the outstanding balance and just paying it. So,
yes, if you are fortunate enough to have the option to even care about what we're about to talk about, because that means you have the money to prepay down your mortgage, that's obviously a good thing.
Something like if you just came into an inheritance, or you have access to some invested money, or you've got a surplus of like, okay, well, what do I necessarily want to do with this?
Let's just talk about someone who's able to bank, $2,000 a month. And should you pay $200 extra towards your mortgage every month? All right, welcome back to MillenniUP, guys.
Really riveting topic for you today.
It's better than what we've been talking about recently. I shouldn't
This is
despair.
Seth's passion project.
Well, listen. This is definitely more of like a financial lifestyle topic, but should you pay off your mortgage early?
So this is going to be targeting people who already own their homes. But so you brought this to my attention, and I know the intricacies that are going to go into this, but I'm pretty sure that everybody's knee-jerk reaction would be, yeah, because who wouldn't want to pay their mortgage off early?
What do you think?
Well, I know about prepayment penalties and everything like that. I mean, listen, if you have the means to pay off your house, cool. But there's more that goes into it than just saying, all right, I'm going to pay off my house and seeing the outstanding balance and just paying it. So why don't you get into it then and tell us why this was really exciting for you to do?
Well, it's a lot like much of what we discuss, and it really does depend. Depends on your interest rate. Depends on whether you got the money or not. It depends on what your investment strategy is overall. So, yes, if you are fortunate enough to have the option to even care about what we're about to talk about, because that means you have the money to prepay down your mortgage, that's obviously a good thing. We want to kind of talk about the intricacies of who should and who shouldn't, and we're not financial planners, we're not accountants or anything like that, but our general sense from our clients' experience is that there are people who just have kind of like a principled goal of like they want to own their house.
This has only been like 1 minute, and I'm already starting to have my wheels spinning of like why you might not want to pay it off entirely. Because I'm also thinking, who is coming into this amount of money that they can just decide, I'm just going to pay my house off casually?
No. This isn't about like, okay, Aunt Betty died and I got all this money, I'm going to pay off my house. You can do that.
I'm thinking like if you just came into an inheritance, or you have access to some invested money, or you've got a surplus of like, okay, well, what do I necessarily want to do with this? I'm kind of thinking about it. And you're right, when it comes to interest rate, like depending on what it is, like if you have a low interest rate, like say like you have this bulk of money, but depending on how much it is, do you want to put some towards a house? But if you invest it into something else, it can grow more. So that's more of an investment play. So now I see where you're going with this.
So basically, like if you have a 3% mortgage, and let's say you have $100,000 that drops out of the sky, you have
where? Let me add it.
But if you have a 3% mortgage, or you can take that $100,000 and earn 10% in the market, the math's just upside down. Like just keep your low mortgage payment, because the slice of your payment that actually goes towards interest is a lot lower when you have a 3% versus like a 10% or something higher. So that's always the deliberation. But like let's not talk about the $100,000 falling out of the sky. Let's just talk about someone who's able to bank $2,000 a month.
Okay.
And should you pay $200 extra towards your mortgage every month?
So first of all, I'd like to specify, if you are going to pay $200 extra towards your mortgage every month, please make sure that you know it is being paid towards the principal. And let's say your mortgage is like $3,000 a month, that you're not paying $3,200 at like your final payment price, because that's just going to go straight into your interest, which like in your amortization scale is the majority of it. You have a section on there, if you do online banking, I'm assuming most people do, to put $200 towards your principal. That pays down your principal and doesn't tack you on interest. So just want to get that out there. There is a difference. Please make sure you're paying towards your principal. Otherwise, you are literally burning your money.
Yes. So that is a question that we get at settlement. We get it before settlement. We get it after settlement. I've had people who say, hey, I just got my bonus. It's like $7,000. Like, should I just pay down my house or should I put it somewhere else? And then, we talk about all these little levers that you can pull on. Generally, if your interest rate is below like 5%, paying off your mortgage early is probably less advantageous just because you can make more money in the market 7, 8, 9% if you give it to a financial planner or you put it into something else that will grow it. But if you have an interest rate over 5%, as it gets towards like where that interest rate you would make in the market, as your interest rate for your house kind of approaches that number, it's a real conversation for you to have. I personally have a very low interest rate. I refinanced in 2021. I still, just because of who I am, I still pay just a little bit more. I pay less than, I think I put an extra like $207. I just rounded up. So I pay like an extra $217 a month. And it's just, if you go to a mortgage calculator, you can go to a million of them online. It's really fun to play with. You can put in the day that your mortgage was originated, the amount you borrowed, and your interest rate, and it will calculate. It'll calculate your amortization schedule because it's just a formula. But then it allows
you can go cry for a little bit and see how much you're actually paying towards your mortgage.
No, but you won't cry. You're going to dry your eye when you see, like, if you put a lump sum like 4 years into your mortgage, or 14 years, or 4 months into your mortgage, you can see the difference in the ultimate amount of money you're going to pay. So it'll give you an option to go and say, hey, listen, I want to pay an extra $100 a month towards my $2,500 a month mortgage payment. After 30 years, how many years is that going to save me? If you put $100 towards a mortgage payment every month, since when you start it, you're going to save like 5 years and tens of thousands of dollars in interest. So sometimes it's not about like, well, hey, can I make more money in the market by putting all this money in and all that? There's a good argument to be made that even if you do have a low interest payment, just putting a little bit extra, and even I don't even know what your interest rate is on your house, but
4.75.
It's 4.75. So even
I bought in
more,
2017.
So even more of a reason to. But even at 2.75, like, I just eventually want to own my house just because that's like kind of who I am. I know people who've done the opposite. All they do is borrow against their house, and then they take the money and they put it into the market. There's a lot of things you can do. People pay for college. People pay for care.
We're going to have another episode too, by the way, probably in the coming weeks, of should you borrow against your house. So if you're also curious about that, that's going to be a whole other topic. But feel free to ask us in the meantime.
Yeah. So it's a big it depends moment, but
well, you have a point, because actually, I mean, because the way that I've thought it is like, okay, what's another $100 a month really going to do? Like, that's 30 years, and it's such an exorbitant amount of money that impact is it really going to make? But now I'm sitting here, I'm thinking about it, and I already know like how little is actually going to the principal of it and how little I have actually paid into my house since I bought it. If that's okay, like $100 a month, that's $1,200 a year. Math, right? Honestly, that's like that in 1 year. That's probably more than I had paid off. Generally speaking, I mean, I have not paid off all that much to make myself seem very like it's a substantial amount of money. Yeah. So like, I encourage people, go look and see how much you still owe see how much your loan was issued for when you bought your house, and look at how much your balance currently is, and see how much you have actually paid towards your principal from then to now. And then think of how much you could just be putting towards that every month to see how much that would be a year. Curious to see what people come up with.
Keep in mind too, guys, is if you pay off your, because we're like kind of dealing with the premise that eventually you're going to pay off your house. Most people don't, because most people move before the loan's ever paid off. But keep in mind, you put that $200 in a month, like that's equity, that's direct equity, that principal, that comes back to you at settlement.
Yeah.
So the other thing you need to think about is that a mortgage is kind of like a forced savings plan. So if you put more money away into the principal and the equity of your home, as long as your home value holds, you're always going to have that equity.
Well, there's a reason
that is an asset that you can borrow against, you can sell, you can dispossess, or whatever.
I was going to say, there's a reason why real estate is considered an asset and not a liability.
That's right.
So
And so it's a liability until the mortgage is paid off, but it is an appreciating asset versus a car or unsecured debt with a credit card, where you're just paying interest because the bank says we want interest.
because they can.
Because
period.
they can. So no, I mean, so it's a nuanced topic, but it can be part of a strong retirement plan, is to just pay a little bit extra. And now you can pay once every month. You can pay like in one lump sum, or then there's some people who make a 13th payment. So there are people who make bi-weekly payments, bi-monthly. I never even know what the hell is bi-monthly, but it's basically every other week. So people make payments every other week. So they will go, and every time they get a paycheck, it automatically gets drawn out of their account, because it's like, as long as they have a W-2, it's just
that brings would that just bring your 30-year mortgage to a 15?
Yeah. Kind of. Yeah. I mean, they don't make two payments, but they pay a little bit more. They'll pay, like if they have a $3,000 payment, they'll pay $1,500 and $1,500.
Oh, I thought you were saying that, say their mortgage payment is $3,000. They pay $3,000 to their principal in 1 week and then pay their $3,000 mortgage.
Yeah, I mean, listen, I mean,
$6,000 a month.
I mean, I have clients who are able to save like $5-6 grand a month between all their housing expenses and everything like that. And like, those are the people who obviously have a lot bigger sandbox to play in. I mean, they can put it into investments, but even people like that, they have to ask the question, does it mathematically make sense to do it?
I mean, that's pretty much what the answer is going to come down to this entire topic.
And it's going to depend on like whether, and like maybe you have that extra cash, but do you want to save it for a vacation, or do you want to put it into a 529 for the kids? By the way, if you guys need any financial planning advice, we've got like 4 or 5 that are outstanding.
So this topic from us really comes to really getting you to start considering other things and showing that it's not necessarily a black and white statement of like, should you or shouldn't you? It's you can, here's how it can be beneficial. But hey, let's get you with a financial planner to actually tell you what the best and highest use of this money is going to be to get you more money, because it could be a wise investment to put it into your home, or it could not be. Yeah. Or honestly, I think it's never going to be a bad investment to put more money into paying off your home. It's just a matter of, can it be a better investment somewhere else?
Well, yeah, I would agree with that. But yeah, someone's got to.
You agree? Oh, look at that. We've had a lot of disagreements today.
I'm exhausted. No, 2.7. I have a 2.75 interest rate, and financial planners will probably think I'm nuts. But it's not a lot of money to just put an extra couple $100 just so I know that, when I'm in year 23, it's paid off, and not year 30. You know? So it's an extra $2,500 a month or a year, but we'll put in the show notes like a bank calculator or a mortgage calculator. You'd be amazed.
Have some fun, play around with it.
Play around with it, and you'll cry, and then you'll dry your eyes, because then you'll
that'll be a tissue.
I actually sent this to somebody who I know in my family, and we were sitting at like some brunch, and she asked me this question, and I actually got onto a Loom, which is like a video email, and just like walked her through it. I asked her for when she took out her loan, how much she borrowed, and what her interest rate was. And then I just showed her all the different scenarios of like, okay, well, if you did this, and she had a high interest rate. She had like she had an interest rate from like back. And I showed her all, I think, and now she prepays her mortgage like just a little bit. It's like $75 extra, but it's going to save her. It's not
that's the thing. Like, even
loan.
if you're not coming into globs of money and the sky isn't raining money on you, even just like you're gonna get it back. Like that's what it comes down to, is like you're putting it in, but it's like putting it in a safer piggy bank.
It's like it's like a forced savings account versus any kind of investment or E-Trade account or whatever. I mean, that has the ability to go way down. Like, real estate is very safe because it's slow. You can't panic sell a house, but like some guy on Wall Street can panic sell your account or like ETFs or whatever. These funds can be very volatile, but housing is usually very solid because it's slow. So there's a lot of runway up towards a depreciating event, if you will.
Oh, but there's going to be somebody in a comment who's going to say, but what if the market crashes and then you're not going to get that back? Yeah. We're going to do another episode about why the market's not going to crash.
You're really on the record saying it's not going to crash.
I am. Listen,
I think in this area, I think we're in pretty good shape. But we just did one about Florida and Texas, and that's not the case. And when
would
this
you say
airs,
soften or crash?
So,
Balance or crash?
Yeah, crash. The technical percentage for an economic crash is 38%. That's like the technical term. So
Listen, feel free to at me if I'm wrong.
Yeah.
And the world goes into ruins because the entire country is in a massive crash and we're going straight back to 2008 and everybody's losing their homes and all home values, every single one of them is going to lose value at me.
But let's talk about that scenario. Like if the markets are down and everything is crashing and everything's falling,
The sky's on fire.
no
more money.
No, and you still have your job and that might be a time to put it safely into your equity of your home, because real estate is not going to go down the same way that a lot of those funds went down during the Great Recession. I mean, people lost their entire retirement, pensions, everything.
So glad I was
And
too
in
busy being in 12th
Philadelphia,
grade.
we did not see the crash. We had a correction, but we didn't have a crash. The places that got all the ink were Florida, Texas, Arizona, all these places that had a ton of speculation, ton of buildings. So if you are at all curious about the difference between our market and Florida and Texas, you should go back and listen to that episode, because that's a pet project of mine. That's a passion project of mine.
He loves that one. I like it. It was a good one.
Yeah. And I have an app that I use that I can go around and see whether inventory levels are rising. Because if inventory levels rise, that means that there's just more options, and there's only so many buyers that will absorb it. Mm-hmm. And I mean, you go around Florida, and it's just all the inventory levels are going straight up and like way past like pre-COVID. So I'm thinking this time next year, which is late 2025. I think that I think the secret will be out on those markets.
Well, we'll see what episodes we're putting out in 2025.
That's right.
All right. Anything else to say on this topic?
No, man.
What are your final thoughts?
My final thoughts is that it can make sense. Definitely play with a mortgage calculator, and never forget, when you are at the table but signing that contract for that mortgage at settlement, never forget 30 years is the bank's plan. It is not your plan.
Are we even going to talk about prepayment penalties?
No, because there's so few loans that have them now.
Yeah. I just know people hear of them.
That's
I've
not
had people
really a
ask me
thing.
about
That's not
them.
really a thing anymore. Not really. I mean, if you have a prepayment penalty, you're not in a conventional. You're probably not in a Fannie or Freddie conventional loan. Like, you're probably in some kind of like, what's it called? What did we put the woman in Birdsboro in? Come on, the non-Q. Non-conforming loans. Like, those types of things have prepayment penalties because they're privately underwritten. I think some jumbo loans can have them. But FHA, VA, USDA, and conventional, I don't believe should be issued with them. At least the people that we work with don't issue them.
Okay.
If there are, you should always check with your lender just to make sure, so you don't get a prepayment penalty.
I just say, just don't assume. I mean, put it this way, chances are not, but
I'll tell you what, don't believe anything we just said. Check with your lender and everything like that. But in the end, it's good practice to think about and pull on that lever. Just remember, you will get that money back as long as your property maintains the value of your equity, not the value that you bought it for, but even the value of the amount of equity you have. You will always get that money back if you ever decide to sell.
Yep.
So
tune in another time for Should You Borrow Against Your House?
That might be more relevant soon.
Yes.
Because I think some people might want to start doing that. Instead of moving, they're just going to borrow and use that money to pay for things.
Can't wait to talk about it.
Yeah.
All right. Until
See you
next
guys.
time. Bye.